Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. Against the horror of the ongoing Ukrainian crisis, there are now more than 4 million refugees. It's ironic that financial markets have been comparatively stable. The standout has been equities, up almost 9% from their early March lows, and 5% higher than they were on the eve of the crisis on the 24th of February. Extraordinary. It's all the more remarkable when you think of the other challenges they've had to face. A US Federal Reserve tightening into a slowing economy, oil prices up 40%, wheat prices up 30%, and gas prices up 80% year to date. In addition, the normal stable asset class, bonds, has seen some of the worst returns this quarter that we've seen in several decades. Against this backdrop, how should investors react? What does it mean for asset allocation? And what does it mean for your portfolio? We'll look at this in the slides ahead. Let's start with asset class returns in the left-hand panel. The red line, gold up 5% for the year to date. World equities down 4% in dark blue, and world bonds down nearly 8% in light blue. I've also shown the performance since the Ukrainian conflict started in earnest on the ground, that dotted blue line, and you can see extraordinarily that world equities are higher since the fighting actually began. That's ironically not unusual. It often happens in conflicts. On the right-hand panel, you can see the VIX index, that measures equity market volatility, surging into the eve of the war and then subsiding sharply back down below 20. That's extraordinary calming of equity markets. In the upper panel, I've showed the US dollar index, a steady upward appreciation over the last year, but comparatively small moves since the crisis. So again, a message of subdued and relatively calm markets, given the trauma on the ground. Why is this? Well, first of all, I think people have hoped for some sort of a settlement, and it's possible. NATO was the flashpoint for the crisis in the first place. Could neutrality in Ukraine in some form or other be part of the solution as the ongoing ceasefire talks continue? On the right-hand side, you can see how commodity markets have reacted. They initially spiked, wheat, oil and German natural gas there, then beginning to calm, still huge moves, wheat up 30%, oil up 40%, gas up an extraordinary 80% year to date. But that initial spike beginning to roll over. So perhaps there is some thought in the market that the duration of this crisis might not be quite as long as many have thought. The second issue is that the damage to the global economy, while meaningful, is not pushing us anywhere near recession. I've shown in this chart our projections for global GDP for 2021, 2022 and 2023. The figure in brackets is the number that we had in our forecast 6 months ago. Now, if you take the US line in 2022, we've come down from a 3.8% to a still robust 2.9% growth rate projected for this year, and 1.6%, albeit quite markedly slower, for 2023. In the UK, we've actually upgraded the numbers because of a very strong Q4 number that came in at the end of last year. All in all, for the world, we've downgraded GDP by about 0.4 to 0.5%, which is meaningful, but again, does not herald recession. So the market is pricing in a slowdown, but perhaps not a recession. Thirdly, the likely trajectory of interest rates, while steadily upward in the United States, is not expected to reach anything like the highs, the terminal rate, that you've seen in previous oil price shocks. We expect a steady round of rate rises at most, if not every meeting, with certainly some rate rises of 50 basis points rather than the quarterly increments we've seen to date. Our baseline forecast in blue sees rates rising to 2.5% next year and then falling back to a steady rate of 2.25%. In other words, the Federal Reserve going a little bit further than it needed to slow some of the pricing impact. Now, of course, this is full of uncertainty. At the same time, they'll be trying QT, balance sheet unwind. We've talked about this in earlier programs. That's highly uncertain, I think will be driven very much by the economic data. Also, of course, as we all know, monetary policy is a very uncertain tool with long and variable lags. So this gives you some feel of the move in interest rates. Orderly, faster, yes, but not higher. But uncertainty, of course, still prevails. What does this mean for inflation? Well, I've taken the OBR forecast here, that's the Office of Budget Responsibility here in the UK, and I've shown the inflation rate right back to the 1970s, when we topped more than 25% at a headline level. If you look over to the panel on the right, you can see the figures today. The yellow line was the projection for inflation back 6 months ago. The blue line is the position today. And you can see again, the OBR expect that inflation rate to peak over 8%, but to settle back down at target somewhere around end 23, early 24. So while this is a very painful inflation shock with huge consequences for the cost of living, it is thankfully not too long in duration if these forecasts are right. Fourthly and finally, I think investors have looked at the stability of underlying earnings. I've shown in the left-hand side global earnings per share 1 year forward, so these are analyst projections. You see that sharp rally after the COVID lockdown, and in general, equity profitability is still on my measure about 25% higher than it was on the eve of the COVID crisis. So earnings numbers still robust. On the right-hand side, I've looked at dividends, which we expect to grow a little slower, but still at 17.5%, an extraordinary rate for 1 year ahead. So the underpinning of robust dividends and robust earnings supporting markets. So I hope this gives you 4 good reasons to think that equities can continue to perform despite the trauma of the conflict on the ground. And I hope it gives you confidence to hold equities at the core of your portfolios at least a market weight, focusing on strong thematic drivers like the new energy economy that will emerge from this crisis, and also on equities with strong, progressive and recurring dividends that can act as an alternative income source to bonds. Finally, and most importantly, our hearts as ever go out to our Ukrainian friends and allies. Thank you.